All right, though, we didn't get the start to the week that we were hoping for. We had a little bit of hope last week, on Friday especially of last week. We talked about what we'd like to see today if we are going to have that kind of rebound move on Friday's market outlook. But, again, the likelihood of that happening wasn't necessarily high. And we talked about a lot of patterns that would suggest we're headed towards a corrective move, more of a correction. But you remember, a correction is an extended decline, extended duration decline. Below the 200-day moving average. It's not like we have to tank, but it's a move below the 200-day moving average where we pretty much stay there and make a run towards the 200-week moving average. So that's a correction, and that takes time to do that, to make that move, more than just 13 days that we've been in right now. It also takes time to recover back up to new highs. It takes months. So that's really what we want to avoid as much as we can, but there's a lot of things that are pointing in that direction. There's a lot of similarities still. Last week we talked about the similarities between last week and that week of January the 17th, 2022. Today there's a lot of similarities now between this week, so far after only one day, admittedly, but the week of January the 24th of 2022. So uncannily similar. We'll break down those similarities, what's driving this action, why there continues to be higher odds than normal of us heading into a correction and more than just a pull. A pullback move, again, is a move to the 200-day moving average that we bounce right back off of, get back above the 30, and make a run back up to new highs quickly, right? That's a pullback. I don't think we're in that kind of move. So we'll talk about why, what's driving this. We'll take another trade today in that XLK, XLY space, and to the bearish direction, of course, knowing that we might get a pretty decent move to the upside. So in the Market Outlook Live, we talked about how to hedge that. But that will be our trade idea for today. So let's go ahead and get started. Today is Monday, March the 10th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live videos, where, again, I take a look at old trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. Look, we got the 50 likes. That's great. Let's see if we can get up to 60 now. We used to be in the hundreds, so let's see if we can't get back to that level, but we'll do it slowly but surely. See if we've hit 50. Let's see if we can get to 60. Click this thumbs up. That takes you, when you click that, it takes you here. Hit that like button. Same thing here. Click this thumbs up icon. It takes you to this page. Hit this like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. All right, let's go ahead and get started and take a look at the S&P with the market forecast indicators. You can see we obviously continue lower today, closing below yesterday's low point. Bearish day, but we came off the lows. We didn't finish down 3%. We were down 3% at one point in time. We'll talk about the significance of that here in a minute. From this chart's perspective, this is the lowest point we've been below the moving average all year. Remember on August the 5th, that really crazy day that we had where we were doing okay, and then we had this one big down day that we rallied the rest of the week and finished barely negative. That day we finished almost 6% below the moving average. Today we are more than 6%. So it's not the highest, it's not the lowest, excuse me, the biggest number there. It is in the past year. It's not in the past 5 years. You can see we're still in the 52nd percentile. If I take away COVID, so let's go outside of COVID and just stay in the 4-year time frame, we are in the 17th percentile. So you can see during some of these time frames, in 2022 during the correction, we were really down below the moving average, almost 10% on some of these, and we did on the initial pullback stage, we eventually got down to about almost 7% below the moving average, so a little bit lower than where we're at right now. Going back to just what the chart looks like, the near-term line is still in bearish territory, so we're still waiting for that day where it bounces up, right, where we get across above 40, hopefully above either 50 or 60, and then a good strong momentum move to the upside to kind of change this around, get the intermediate line going back to the upside. So that's not the case yet. The intermediate line is still in the reversal zone. No clusters, thank goodness. No clusters there. Even though a cluster might be what we need to kind of end it, right? You can see usually clusters kind of end these. And then the market sentiment line still falling. Still falling down to the downside. So the NASDAQ had the biggest drop today. Almost 4% for the NASDAQ 100. It is down about the same level. You know, at one point in time we were down 8.95%. So it's a little bit not as much, not quite there as we saw on August the 5th, but pretty close. Again, very similar. Oversold momentum line, near-term line still in bearish territory, but not. You know, again, it's going to cross one of these days. It's going to cross and give us a some kind of peak. Whether it's bullish or bearish would depend on what kind of cross it is when we get outside of 40 there. Intermediate line in the reversal zone, market sentiment falling almost. Well, now it is actually into the lower half, just barely, but it's into the lower half of the chart again. We went barely below the lower half during this decline as well that we had in August, and then that subsequent kind of early September small little pullback there. Let's take a look at the Dow Jones Industrial Average, and you can see again dark pink shading in a red line, intermediate line in the reversal zone. Remember, it did cross 40 yesterday. It didn't cross 40 and 50 and 60 or 50 or 60, right? But it did cross 40, and the momentum line was higher. It was not in the reversal zone, but it was higher. So it looked okay on Friday, not so good today, right? Near-term line back, it's supposed to get above 80 in 2 days, crossing 40 on day one and then crossing 80 on day two. So that's kind of the ideal scenario to kind of, get escape velocity, so to speak, on a short-term run. Obviously, that's not the case here, and we are at the lowest point below the moving average of the year, well below where we were in August. We didn't really drop that far in August, and it'd be below this point that we had there on December the 18th. Was the last time the Dow was really low. And then finally, the Russell 2000. Remember, the Russell 2000 is in correction. Remember, correction is an extended period of trading below the 200-day moving average, right? That is the definition of a correction. The Russell is in a correction, right? So this is a little different than the S&P, which just barely closed below the 200-day moving average for the first time today. The Russell had its pullback to the 200-day moving average. It's had its failed pullback bounce that was at least a 5% move or higher there. And it got a bear tag, no less, on that day. And then, now we're to new lows and we're below the 200-day moving average. Again, it crossed above 40 on Friday with a higher momentum line, about as bare minimum as you can get there from a near-term rally. And obviously it didn't play out as we were down below, down almost 3% on the Russell as well. At the lowest level, 9% below the moving average here, which is the lowest level of the year. Again, lower than any of these other instances, December the 18th or August the 5th that we had, or even during when we had all these we had 3 clusters in a row back in April, and but we were not even close. We were only about 5% below there. So 9%, but still no cluster, right? Still no oversold cluster. We'll see if we get one tomorrow. There's a good chance if we're bearish tomorrow, we get one tomorrow, but I think there's a pretty good chance that we kind of bounce out of this tomorrow, as extreme as today's move was. If we take a look at the weekly crossover chart, you can see we are below the 40-week moving average, for the first time since that last week in October, when we at the end of that intermediate run. Again, you can also see back over here, a very similar break of the 40-week exponential moving average, and then we rebounded. Back then we were 3 3/4% below. The gap between these lines was 3 3/4%. Now it's below 3, and it's moving towards 0 again. This is the biggest bearish candle we've had since that candle we had, obviously during all these instances. But this is the biggest candle we had during a pullback since that candle we had in July 24th. So if last week was very similar to the week of January 17th, so far this week is looking very similar to the week of January 24th. In terms of, and go back to Friday's market outlook if you need to see kind of all the comparisons we've had. Remember, I've been comparing 2024 to 2021 in a lot of ways. And last week was uncannily similar to that week of the 17th. The only difference was we didn't finish with an oversold cluster on the daily chart like we did back in January. And that was an options expiration week, no less. That was the only difference. We rebounded on Friday last week. But we're back. You can see how bearish we are. And again, looking very similar to the successive week that we had on January 24th, where we actually dropped down and we actually had some up days in there, and then we hit our low point of the pullback during that week, and we'll see if that ends up being the case. Maybe we've already hit that low point. If you take a look at the 3 green arrow chart, well, let's take a look at the actual 3 green arrows first. On the MACD and stochastics and the 6-week moving average, again, you can see three red arrows across the board. Stochastics oversold on all 4 indexes, red lines on all 4 indexes. I mean, clearly intermediate decline there. If you take a look at the 2-line versions, remember, like I said, the first day for the S&P were below the 200-day moving average. The MACD is way below, it's way down here. It's dropped well below the -1% mark, right, which is a key level. Just like 1% is kind of a key level in terms of a normal rally to the upside. Well, it's also a key level for a normal pullback, unless we are having something a little bit more than a pullback, like again in early 2022. So again, this was that first down day in the first day of that week, the 24th, and we actually got the low point that day on a Thursday before rallying the close on Friday. But that's when we actually got ours, and you can see we were down to -2 on the and right now we're at -1.5. So we were at -1.5 then on that day, that Monday. So we're a little bit lighter now than we were then in terms of momentum, but the momentum kept going down even though the histogram started to roll up by the end of that week, and we'll see if that ends up happening this week as well. I would expect that to be the case this week. If I take a look at some of these other oscillators, you can see the DMI, we're above 30. We are way below 10 on the positive indicator, so very significant decline. So you remember how I was talking about back here in late February, we talked about the idea that that we had this extreme, like in all my classes too at Market Scholars, we talked about how we had these extreme lows in these kind of volatility indicators, including in this case the ADX, so extremely low, and that we were potentially popping out to the upside, but also had the makings of a fake out because of how small the breakout was, how small the moves were. Well, that definitely has played out in terms of a fake out, as we have broken out in a big way, but to the downside. As you can see, again, like I said, extremely low on the positive indicator, and the negative is not really that high, and the ADX is just spiking really quickly up to the upside. The RSI is below 30. It closed today just a little bit below 30 at 29.9. So that's the first time we've seen it below 30 in over a year. It's been a while since we've been below 30. Again, if I zoom out, we got below 30 on the pullback stage back here in the week of November the 24th. We actually got below 30 on the RSI on the last day of that week, the week of the 17th. And then we really stayed below 30 all week when we eventually set that low point there. So we are definitely there now, and then we're still below -150 in the CCI. In fact, the weekly CCI is down below 200. Again, the last time we were below 200 on the weekly CCI was the week of January the 24th. We were at 233, and this week we're at, where are we at this week? 242. Now, it's only one day into the week, and the week's not over with, but the week wasn't over with that week either, and we had some pretty decent up days that week on Monday and Friday. So we'll see how this plays out here this week. We're almost below 40 on the RSI, so that's a pretty low point already. And like I said, below -100, so that ends the bullish move we had and opens up the possibility of a correction. Because that's usually what happens when you get when the green box stops on the CCI. If I take a look at the Ichimoku cloud, all right, if I take a look at the Ichimoku, you can see it's pink. Both the lines are dropping, which is what this is plotted 26 days forward, what the cloud is. We have a mature bearish trend now. We're below -5 on the trend quality. We are above 80 on the trend noise balance. Again, we didn't get that back here, and the last time we did was the last time we had a mature bearish move. See, we didn't even get a mature bearish move here in 2023. The last time we had a mature bearish move was the week of January the 24th during a pullback, right? During a pullback. Remember, the pullback is the first leg lower of a correction. Now, if the pullback bounces up to new highs, then we don't get a correction. But if the pullback fails, then we get a correction, right? That's That's the idea. I saw somebody say, hey, 10% marks that correction, the correction territory, that we're almost in correction territory. No, 10% drop doesn't mark a correction territory. It marks that we are starting a correction. That's the level where we start a correction. That usually takes months to fall to the lows and then eventually rebound back up to new highs. Versus pullbacks, which only takes a matter of weeks, usually just a few weeks. Usually a pullback, we don't get below the cloud. If we do, we rebound right back up above it. But a correction is, we get below the cloud so far that by the time we get to the pink, to the 26 days plotted forward when we started this decline, by the time we get to the pink, we're still below it. Even with the rally, we're still below it, and we fail and we move lower. That's what a correction does. And again, we have a mature bearish trend, which is kind of hard to end in a single day. It's easier to end these kind of really weak ones, intermediate strength trends, really quickly. Not as hard to end, not as easy to end the mature trends as quickly. Doesn't mean we can't, though, right? Nothing's 100% or 0% in technical analysis. Finally, let's take a look at the Bollinger Bands and the Keltner channel. We are in the lowest quartile of an exploding bandwidth. Again, that bandwidth is just exploding. Again, for some perspective on 5 years, again, going back to 2022, you can see the bandwidth got even higher than it is now. And it jumped out of its 150-day range. We still haven't broken out of the 150-day range yet. Again, another sign of a potential correction when you break out of that range, that we didn't have as tight of a range now as we did then. But we are definitely jumping up almost at 10% on the Bollinger bandwidth. If I take a look at the Keltner channel, obviously we are way below the Keltner channel with some significant momentum to the downside. And green dots, the bands are, the bands are way outside the Keltner channels. And you can see this is about the level right here where my cursor is that we got down to that week in terms of negative momentum. So we may still have a day or two left. But I think at some point in time, most likely this week, we'll probably get some resolution on a low point being formed. And when we do get that low point and we bounce and get a new green tag, and today might be the low point. I don't think it is, but it could be. But when we bounce up 5%, it's going to be rapid. It's going to be very, very fast and very rapid, because that's how it happens when you get these correction lows that are closer to 10% versus 5. The ones that drop 5%, they take a little bit longer. Not too long, right? Still just weeks to get to new highs on pullbacks. But when you get these that are closer to 10%, you can see that first 5% move is explosive, right? It's very explosive. So again, it could very well happen. I tweeted out today that my take is I think that we will get that green tag before March options expiration, which is next Friday. That's when I think we'll get that green tag formed here. If I take a look at today's intraday move, you can see, obviously a lower high and a lower low, and we ended up closing, despite the rally at the end of the day, we closed below yesterday's low and last week's low so far. Obviously, we had a lot of volume, and here's the Arun indicator, still 100 because we got a new low there, and you can see we're getting close to 10% on the channel width. So we're really getting a lot closer to the end of this pullback. The question being, of course, whether the pullback bounce will fail or not, which is increasingly looking likely, because to get back to that 30-day moving average right now, we'd have a green tag on the chart before we hit the 30-day moving average. You can see as of right now, assuming no new low, no lower close here, right now we would have a 6.5% increase to the upside just to get to the 30-day moving average. So we'll have a green tag before we ever get to the green, the 30-day or the 50-day moving averages. And that's what, again, if we're already at 5% by the time we get there and they hold for resistance, which is a good chance they will, then we move lower to new lows and we're in correction mode at that point. The correction starts when that pullback bounce fails, because all pullbacks will bounce. 100%. All pullbacks will bounce. The question is whether that bounce will fail at 5-6%, around there, around those intermediate moving averages, 30, 50-day moving average, because that's the ones that a lot of people look at. Or are we just going to blow right through and keep going up, right? That's, usually that will happen if the pullback stays around 5%. If it gets bigger, it gets less likely to not fail. It gets more likely to fail especially like I said, if you can get a green tag before you get to the moving averages. So we'll keep our eyes on that, especially considering we might not have the low point yet, right? We still need to kind of see. If you take a look at the volume and the trading ranges, you can see big trading range again today, big volume again today. So those are big numbers. In fact, when you look at the normalized ATR, we're above the 1 3/4% now. That's about as high as we got over here. We were 1.8%, coming off extreme lows at the time too. But again, going back to the that week of January the 24th, back over here, you can see we were just getting above 2% there. So even on the bullish days like this one and this one, those were big 14-point range and a 9.5-point average. This was a 19-point range and an 8-point average down there. So even the up days had big ranges. So I don't think we're necessarily done. Back over here again, you can see by the time we got to that last this first up day, we were at 1.63, and then the update got us to 1.86. So we are at 1.77 now, and we haven't had an update yet, right? So there's a good chance we do get above the 2% mark, which, you don't really want to get above the 2% mark on a normal pullback, because it typically suggests that it's going to be, that we're going to fail, right? That the bounce is going to fail and we're going to stay above, in this case, the 1.5% ATR for a good chunk of time. We didn't really get back below and stay below the 1.5% mark since the beginning of 2023, and then by coming off of the regional banking crisis low point, then we stayed below it the rest of that time. But yeah, getting above 2% that's not a level we want to get above if we want to avoid a correction. If I take a look at the VIX has been so orderly. It's been amazing how orderly the VIX has been. It's been rising, and it's up to higher levels, and you can see we're at 28, and we're above the 1.05% mark, which typically marks your intermediate declines. Usually VIX will eventually spike up to 115% if we're in a correction, like during the pullback stage. Again, going back here, let me zoom out to that week of January the 24th. So it'd be right into this area here. You can see the VIX actually didn't spike there, at least not nearly as much. The highest we got to was 100% there on the 26th. Later it got a little bit higher. We never really had a VIX spike. Let me zoom out so you can see 2018, right? COVID was obviously a dramatic spike, but 2018 is a little bit more like, and you can see we actually did get 115% during the pullback stage of 2018, which is very typical. And we're close. We're at 108%, not quite at 115. And we're not, obviously we're not above 30 here. We're still below 30. So we really haven't spiked. In fact, I tweeted out today that we have moved as much in these last 13 days in the VIX as we did on December the 18th in one day, right? That's how orderly it's been. Like, we jumped up from below 90% to, we closed that day at 114%. Here, we started the 20th, but before the 20th, we were below 85%. And then we just gradually have been moving higher. And we're still, like I said, only at 108%. So it's been a lot more gradual. The VVIX on that day, December the 18th, jumped up to 100 and, what was that up to? 100 and, here, let's do this. Let's see this better. And let me get rid of that left scale. So the VVIX on December the 18th got up to 130. I mean, we've been gradually moving up to 130 now. So we're just barely getting there. And you can see, like, we're still well above 110. So we're still susceptible to a kind of a washout move in volatility. And you could argue we haven't had a washout move in volatility yet, right? You can see we're high, we're bullish, but we're definitely not like, breaking out. In fact, if you look at the 13-day rate of change for volatility, it is actually pretty high, the VIX here. Oh, that's what I was going to point out. So we still haven't had a single day during this whole 13-day move on the S&P and the VIX. We haven't had a single day of the VIX being above 20%. Like, that happens a lot. It happened in 2021, 2022. It happens a lot. It happened there on December 18th. We jumped 74% in one day. Over here on August the 5th, we jumped up 65%. Sorry about that. We jumped up 65% in one day. 25% the day before that. And then obviously we fell pretty hard and fast after that. We fell 4 days in a row after that one, after that 75% move. We have not jumped up 20% at all this entire time. We jumped up 20% in January 27th after gapping up about 27%. Well, we only jumped up 19 today. We still haven't gotten up 20. So it hasn't, again, we haven't really washed out, but it's still been a very significant move on the VIX. Because when you look at the rate of change over the 13 days, it's been significant, right? So again, it's been a 13-day move since we started this decline. 13 days of decline. We're at 82%. If I zoom out here, you can see, I mean, absent those 2 days where we had those, 75, 65% move, if you zoom out, that's about, again, how big we got in a gradual move there in late November, post-Thanksgiving to early December. It's also about the same move that we had in, going into that week of January the 24th. Very similar move on the VIX then. Really steady and gradual over a 13-day rally. Same thing here. So a lot of similarities, again, still playing out. The markets don't repeat themselves, but they certainly do rhyme because it's the same humans that participate in the markets, year in and year out. We still have even though we might be different humans, we have the same human behaviors year after year. One more thing I want to take a look at, if you take a look at the skew, let's look at the skew for the markets, because that, remember, we've been talking about how crazy high the skew has been and how that eventually that's going to unwind in a big way. Well, we're down below 140. But you can see usually we get down when we get these correction lows much lower, but even like the first pullback lows we get down to like below 135, 130. So we might still need a little bit more to drop, but when we're below that moving average, we're bearish, and obviously that's been playing out. We've been so extreme that the market, somebody in the market was anticipating this type of move because of how bullish skew has been, and now we're seeing that move that they've been anticipating play out over the past few weeks. All right, let's take a look at the asset class comparison chart. You can see over the past 3 months, the S&P is down 7%, but IWM is getting wrecked, down 15%. Remember, it was down earlier on, the end of last year, beginning of this year, before suffering along with the S&P. Remember, during this decline that we've had, it really started on the 20th. So let's see, let's go back to February the 20th is when this all started. Let's see, we finished that day down on the 20th right here. We finished that day down and we continued down on the 21st, and then which is Friday. Well, now they're both down. The Qs and IWM are both down double digits in that 13-day period. The S&P is down 8.5% off of its highs. The commodities are down 5%. The dollar's down almost 3%. So and yields are down. Like bonds are up. So that three-headed monster of yields being down, the dollar being down, and commodities being down, that's generally been very bullish for equities. So it's very interesting that has not been the case over the past few weeks, right? It's actually been coinciding with some really significant bearishness in equities. Taking a look at just today alone, so let's come out here to March, and we'll look at today. And you can see the Qs are down almost 4%. The S&P down 2.5%, coming off of its lows where it was down more than 3%, along with IWM. International stocks getting hammered, all right, so they're not really helping out. The dollar was kind of flat. Bonds were up 1%. Remember the TLT, that's the big canary in the coal mine that we've been kind of watching, because remember, you won't have a bear market unless bonds really start to take off to the upside. And bonds have been so beaten up, still below its 200-day moving average. TLT is, but still below here these weekly averages. Had a little bit of a drop last week and then up so far this week. But the MACD is not positive yet. It's we've been pretty darn negative on bonds below the 200-week moving in a bear market really since the beginning of 2022 when the Fed started raising rates. We really haven't been able to get going because the Fed's not cutting rates yet. That's usually when yields start to take off to the upside, bonds start to take off to the upside and yields start to fall. Well, that's happening because if you look at the the 2-year yield, which measures or reflects the expected path for rate cuts, it was down a lot today. It's down to 3.9%, down about 11 basis points from 4% at the end of last week. Remember, the current range is 4.25 to 4.5. So the 2 years now pricing in cuts in a big way. In fact, the spread between the 2 and the 10-year has actually been slowly moving higher, right, during this period of time. Here's the 20th right there. So after falling initially, it's been slowly moving higher here. And the 10-year yield, you can see, has been dropping as well, falling also down about 9 basis points here. So, and the odds for a rate cut are starting to increase. They probably won't do it in March. It's still very unlikely they'll do it here in a week, right? We have the FOMC in a week. We do have the CPI report coming out here later. But it's, you about a 6% chance, here, let's go to March. A 96% chance of no cut in March. But look by June, and there's been some people chattering about May, but the Fed usually doesn't like to make its first move during a meeting where they don't give their dot plots, right? Their projections. They like to do this with a 50-50 chance right now. Most likely the first cut would be in June. And right now you're at 94% chance of a cut. In December, you're looking at 100% chance, 99.6 of one cut, about a 95% chance of 2 cuts, and almost an 80% chance of a third cut. So the market's back to pricing in. They had been taking it off the table. We've been very bullish, but now they're back to pricing in a cut cycle here, which is not what we wanted to see. So that the Fed and their cuts, if they're cutting, then that means yields will start to fall, and that's kind of what we've been missing, right? The one thing we missed during this, after this spike in yields, is for yields to fall back down. We haven't had that. Right? Usually yields start to fall back down during a cut cycle, which we had a little bit of it. We had a mid-cycle adjustment. The rates actually increased during that time, but we haven't started to falter back down like we do when we are setting the stage for a bullish, secular move to the upside. So that potentially is coming here, obviously starting in June. I mean, as of right now, very high probability, very, very high probability that cut starts in June, and that will bring all these lines down, bring the yield spread back up to closer to 200, 250 basis points, which is the norm, right? That's the norm for it to get to at the end of a cut cycle. See, at the end of this cut cycle, it got up to like 33 basis points. That's not the norm for it to get that high, especially when it was so inverted. It's one thing if you go all the way back to the mid-90s, the last, soft landing. See, we never did we had that rate cut, the right here during this time frame, we had the mid-cycle adjustment, just like we had now, just 3 cuts spread out over more months, but still just 3 cuts there. Yields rallied off of the low point, but that low point there never did get inverted like we did here. And so when it rallied up and it got up to 50. And again, that's not typical for a rally to get to. It was just a mid-cycle adjustment until we got inverted, and then we did get our typical decline. And so we haven't had that yet. This is not a peak, a typical peak. It's more likely going to end up 200 to 250 basis points. That's where the yield spread typically peaks, when we've had a cycle of cuts, of falling yields and cuts. And I think that's kind of what from the sounds of it, is what the administration is kind of angling for right now. The breadth has been okay. The breadth actually wasn't bad again today. When you look at, now we'll look at the volume here in a second. It has been bad, money flow. But the breadth itself has not been that bad when you look at it here. You can see, we did drop below 0 on the summation index, and we did actually now, by the end of the day, it got to minus 56. Earlier in the day, we were just in the 30s. Like, it wasn't that bad of a breadth. It ended up being a little bit worse. But still, that's not, like you can see, that's not like, we've been a lot lower. During just typical pullbacks, we've been a lot lower. In fact, during the pullback stage, we got down to like 75, 80 during the pullback stage. So, we might, that's kind of a sign that we might not be done. You can also see, too, during that initial stage, we were also barely crossing 0. We had dropped down below 0, made a run up above it, and then fell back down during that stage, similar to what we're seeing right now as we speak. If I take a look at the number of stocks above their moving averages, like these other breadth indicators that we like to look at, you can see this one's not too bearish. We're still above 200. We're not at bearish levels yet. The big one is this drop. The number of stocks above the 200-day moving average dropped hard below 250. We barely dipped our toe below 250 a couple days ago. We dropped hard below 250. So that's a big change in sentiment, Because again, dropping below 250 on this index, numbers talks about the 200-day moving average, is a big deal. And usually these pullbacks unwind. Let me zoom out so you can see that at early 2022 level. These big pullbacks unwind when we get these big spikes. Like, see these typical pullbacks, we get these big spikes. Well, here's that first move in 2022, and we got up to 140% during that drop. And right now we're at 123%. So, we're really, we're above the line, but we're not really like washing out here. We're definitely not at 200% or 2 or 1.5. Like, you can see, some of these other spikes that we've had, and we're definitely not spiking. So, from the breadth perspective, we are not washing out right now. Looking at the new lows, we did jump back above that pivotal 4% mark, which is that red line. Remember, when the lows are above 4%, that's usually either is a washout of a pullback low or an indication of, especially if it's sustained, the beginnings of a correction, more of a corrective move. The net new highs and lows, are back down to significant levels below minus 400. So that's a significant deal. From that perspective, the breadth has been relatively poor. I told you about the money flow. The money flow is pretty weak too. You can see, we are down now well below 40, getting close to really bearish levels below 20, which we haven't been. This is the lowest level we've been in a while. So, if you take a look, the last time that we were at this level was way back over here, and you can see, like, we're not anywhere close. So on one hand, like, this might not be as bad as it seems because of how weak and the breadth has been, how weak the money flow drop has been. On the other hand, we might not be done, right? If there's going to be, a bigger kind of wash, we haven't had a washout move yet. That's the other thing. So we just haven't really had a big washout moment. And it looked like today was going to be the day. We didn't even finish at the lows. There still might be that kind of day. We might go up tomorrow. We might go up on Wednesday. We might not get that kind of moment till like later in the week, Thursday or Friday, before we can finally set the low point there and then rebound again. And typically the rebounds of these types of moves are very explosive. We get that green tag very, very quickly. All right, let's take a look at the sector rotation. You're not going to be surprised that technology and discretionary are your biggest losers. Of course, I think I showed you on Friday how they've done since over this 13-day period. But if you take a look at just today, again, they're the biggest losers. Technology, and we're rotating away from what we want to. We don't want XOK and XLY and XLC to be in these categories. We want them to be in the green, and that's on the daily version. But the weekly just looks so bad. Down to the left, way up to the right in all these safety sectors and cyclical areas that are not correlated positively with risk appetite when they're, with their ratio charts. The XOK on its own, you can see on the daily chart plummeting there. But on the weekly chart, remember we had closed below the 17-week a couple weeks ago. We're well below that. We're not rebounding back up like we've done the last few times we closed below the 17-week. In fact, if I take a look at XOK on this chart and take a look at it on a weekly here, let's go to this ratio chart first, and then we'll take a look at XOK and do it on its own absolute value first. You can see the big drop here. Let me zoom out to 5 years. You can see the big drop here, well below the 17-week moving average, and we are clearly below the 50-week moving average, making our way down to the 200. The PPO is very clearly negative. Again, we haven't been this negative in a while. The CCI on the weekly is very negative. The PPO is falling from very high levels. You can see the DMI has just barely turned to a negative level, and the RSI dropping below 40 on the weekly chart for the first time again since over here in 2022. Again, for the first time on a ways down. Obviously, we were down below all these other weeks, but we're dropping now, so we want to compare it to other times where we're dropping, not when we're rising. A lot of times people say, oh, we haven't been below 40 since October 2022. When we're at, so we think, oh, maybe we're at the low point. No, we were bottoming then, and it rallied up. So if we're dropping below 40 now, we want to look at other instances where we dropped below 40 for the first time too, and that happened to be in early March, where we also, dropped below the 50-week, made a move up over a 3-week period up to the 30-week and failed before working our way down. And so, again, that's obviously you can see that's a very real possibility again, depending upon how this week finishes up here. All right, and that brings us to our trade of the day. It's actually kind of on a technology type discretionary type stock, so it kind of fits both bills here. It's on Expedia. Expedia has actually been holding up pretty well, but finally kind of broke down today. You can see we got a bull tag late last week, and then it kind of held ground on Friday with that long lower shadow. But today we finally broke down to dark pink shading, crossing below market sentiment, bearish short-term sentiment there, but not too extreme. But bearish short-term sentiment. You can see the weekly chart on Expedia is not looking so hot either. We are down. We got the red arrow last week. We're clearly below the 10-week moving average. The PPO is falling, and you can see one of your bigger bearish candles we've had since the last time we had a death cross on it. Let's take a look at the 3 green arrow chart. Obviously, we have 3 red arrows, just barely, over the last 3 days. 3 red arrows there. Let's take a look at the 2-line version of this chart. It'll let me. There we go. Pull up Expedia. We are not below the 200-day. In fact, we barely just broke the 50, and there's a pretty decent gap of volume down to the 200. The MACD's has gone negative, stochastics and oversold levels. So there's a good chance we can continue down into the value area and finish this move from the 50 to the 200-day moving average. That's the premise of the trade. If you take a look at some of these other oscillators, they are also turning bearish here. Bearish breakout type patterns above 30 for the first time, below 20 on the positive indicator. If you take a look at the RSI and the CCI, they're also breaking below bearish levels, below 40 in the RSI. We're already below minus 100 on the CCI. The Ichimoku cloud, we're below the cloud barely, but we're below the cloud. We have an intermediate strength trend already. And even though we have a positive rate of change, we're below the blue and the green lines there. If you take a look at the Bollinger Bands and the Keltner channels, we are in the lowest quartile, pushing down. Eventually, I'll get here. Pushing down against the lower band. And we are also pushing against the lower Keltner channel. And the bands themselves have just crossed back outside of the Keltner channels. So bearish setup. And so what I decided to do here, and I had a big long discussion, since most of my trades right now are bearish and that we've been doing. I had a big long discussion during the Market Outlook Live of how to hedge that in case we do get one of those explosive 5-day, 4 or 5 day moves, 5% moves to the upside, especially before a lot of these expire. Let's take a look at Expedia, the options channel. Went down to the low 20s delta. It was low 20s at the time. Now it's mid 20s. I did this again at 3:30 Eastern time before the market closed in that Market Outlook Live session. We sold that one. Bought the whatever strike it is. I guess it will come up again here in a second. But it was, it was this one strike away. I think it was $5 wide. It was the 165. Position size for $500 like normal. 3-to-1 reward to risk ratio. Lots of room to work with for flexibility there. And we'll see. We'll see if this continues to move to the downside. And then again, we'll hedge this and all these other bearish trades if it doesn't, right? If things bounce up very rapidly within the next week and a half or so. All right, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up in your thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.